Okay, good afternoon. If we do not have your problem set, please bring it down front so we can get them all collected. So today we want to revisit a topic that we chatted about a number of weeks ago with our saving and investment diagram, and that's the financial system. And we want to review what we did at that point, but also go beyond that to talk about some of the problems that exist or potentially can exist with the financial system. So one of the things to think about in terms of the financial system is think about it sort of like the plumbing in your dormitory or in your apartment building. Right? So the vast majority of the time, we don't think much about plumbing. Right? It works. It's in the background. It's hidden in walls. The water flows this way or that way. Everything seems to be fine. But every now and then, a pipe breaks. Right? And it floods everything, causes a real mess. We can think about the financial system the same way. Most of the time, the financial system sits in the background, doing its thing, allocating funds between those who are saving and those who want to borrow. Everything's fine. We don't have to think about it very much. But every now and then, a pipe breaks. The financial system has a major hiccup. And it's when that pipe breaks or when the financial system has that big hiccup that we want to have a better understanding of exactly what's happening in the financial system, why these kinds of hiccups can occur, and also think about what the consequences of that might be. So that's what we want to think about today. So at its simplest, we can simply think of the financial system as a way of channeling funds from those who have excess income. Remember, excess income above their current expenditures, what we typically call saving. Savings will turn out to be lenders or investors, right? Something's going to happen to those funds that are being saved. So they're going to get channeled by the financial system from those savers to the people who want to borrow, right? And people want to borrow because they want to spend in excess of their current income. So this is basically what the financial system is all about. It sits in between the savers and the borrowers and tries to match them up one way or the other in an efficient manner. And as I mentioned, when it works well, we don't really pay very much attention to it. We always assume that when the interest rate goes up, borrowing becomes more expensive. There's less borrowing taking place. When interest rates go down, just the opposite. Now, in reality, the financial system is incredibly more complex than what I've just described. But this basic framework of simply channeling funds from savers to borrowers can work really well in terms of giving us the basics of what we need to think about. So this diagram, which is in your textbook and which we've seen before, although I have to admit this actually is an old slide. I had already updated it in our earlier presentation. This should actually be borrowers spenders. So the thing to notice about this slide is over here we have our savers, our lenders, our investors, whatever you want to call them. These are people whose income is greater than their current spending. Over here we have the people who want to spend more than their current income. So these are the folks that need to do a lot of borrowing. Now, if you look at the list of economic entities underneath each of those, you'll see that list is exactly the same. They're households, they're businesses, they're governments, they're foreigners. So we don't particularly care where the funds come from, and we don't particularly care which sector of the economy the funds end up at. We're going to see borrowers and savers in all four of those major economic agents. The funds themselves, though, can actually be channeled in two broadly different ways, in a direct way and in an indirect way. In the direct way, what we see is that these savers and lenders are going to be lending or investing their money directly with the borrowers. So notice that when that happens, the borrowers are going to be issuing some sort of piece. We used to think of pieces of paper. A lot of it's electronic nowadays. That says, I borrowed your money, and here's what I'm going to do in return. Right? I'm going to pay you back a certain interest rate and principal at a certain time. I'm going to give you a particular share of ownership in the corporation, or whatever it might be. These pieces of paper turn out to be liabilities for the borrowers. Right? They're promising to do something in return for you lending them their money, but they turn out to be assets for the savers. The saver now has something that says somebody else owes them funds. Right? Now, so most of these liabilities that are being issued over here can be thought of as either equities, common stock, preferred stock, whatever it might be in a corporation, an ownership share, or it might be a debt instrument, a bond of some sort. Both of those are promises to do something with your money for your particular benefit. Those are the liabilities, and of course, again, the savers over here and the lenders have assets. Now, it's often difficult to match the people who actually have funds over here with the borrowers who want to borrow funds sitting over on the right. And that's where financial markets come into play. Now, in direct finance, financial markets are only there to facilitate the matching of savers and borrowers. Right? How does a corporation who wants to issue stock actually find the people who want to buy it? In most cases, they don't. They count on some institution in this financial market to help facilitate that transaction, typically an investment bank. The same thing is true for corporations that want to issue bonds. They typically don't know who wants to buy those bonds or at what price. So these financial markets, again, often investment banks, will sit there and try to match that. So the financial markets include not only investment banks, but also things like exchanges, right? The New York Stock Exchange, the NASDAQ Exchange, the Chicago Board of Options Exchange, whatever exchange it might be. Now, notice the one thing about exchanges or investment banks. They never own any of these liabilities that are being issued over here, so they never have an asset. They never take legal possession of the funds over here, so they also don't have a liability to the savers. They're only trying to match that up. Okay? So that's direct finance. Indirect finance actually involves an intermediate step. That intermediate step involves what is known as a financial intermediary. There are lots of different kinds of financial intermediaries. The ones that we're most familiar with are banks or commercial banks. Right? If I say banks, always think commercial banks. If I say central banks, think the central bank. I will never say banks meaning the central bank. I'll always be very clear that central bank is a central bank. Okay? So we still see, ultimately, that funds from the savers are still going to get channeled to the borrowers. The difference, however, is that with indirect finance, savers deposit their funds with some financial intermediary. The financial intermediary now issues a liability to the saver. The liability is their promise to do something with regards to the money that has been paid to them. So in a bank, for instance, when you put money in your checking account, the bank is actually just holding that. Their liability is they owe it back to you. Another type of financial intermediary is a pension fund. So when you pay your pension, make your pension contributions, the pension fund has a liability to pay you at generally sometime in the future. So these financial intermediaries then are basically the ones borrowing your money. You have the asset, you have the deposit account, you have the pension, the pension statement, whatever it might be. Now, of course, these financial intermediaries aren't going to just sit on the funds that you put with them, whether it's an insurance premium or a deposit in a bank. In order to fulfill the promises that they've made you, they need to earn something on the funds that you've put into place. So what they do is bundle your deposits with everybody else's deposits or premiums, and then turn around and lend those out to ultimate borrowers. Now, these borrowers over here, again, issue a liability. It's generally a debt instrument of one sort or another. Right? But they're saying, we will pay you back. So notice that now there's a liability still being created over here with borrowers. There's still an asset held by the savers, but the liability of the borrowers is not to the original saver. The borrower's liability is to the financial institution, the financial intermediary. The financial intermediary now has a liability back to the saver. So the financial intermediary has an asset and a liability about the same size, so in some sense we could net that out. We still have the liabilities over here and the assets over on the left. So whether we do direct finance or indirect finance, we're still trying to do exactly the same thing. How do we channel funds from those who have excess funds, savers, whose current spending is less than their current income? How do we channel those funds to people who have insufficient funds, that want to have spending greater than their current income, the borrowers? Right? Two different ways of doing that. Now, when we think about financial intermediaries, this indirect approach, we can break that into two broad categories. What we call banks, commercial banks, depository institutions. Right? So these are your Bank of Americas, your Wells Fargo, your Mechanics Bank, whatever commercial bank that you may know and love and have your checking account at. And then we have a whole second group of financial non-bank financial intermediaries, sometimes also called non-depository financial institutions. So none of these other institutions take deposits where they have also created a checking type of an account. Right? So some of these might be things like insurance companies. You pay a premium. The insurance company gives you a policy in return. We will perform under certain conditions. You have a car accident, your house burns down, whatever it might be. Right? And then that insurance company needs to invest all the premiums that have been paid in order to earn the money to make good on the claims that it might receive. The same thing is true of a pension fund. People make pension contributions. The pension company then makes investments of one sort or another with that in order to earn the money to make the future pension payments. Finance companies, mortgage companies, mutual funds, hedge funds, all of these are doing pretty much the similar type of financial intermediation. Taking funds from one group of people, the savers, doing something with it, but that translates or channels those funds to people who are the ultimate borrowers. Keep in mind, the liability of this, the asset that's owned by the saver is a liability of the intermediary, not the entity that the intermediary lent the money to. Okay? So again, if we come back to our diagram, one thing that's important, if you lend money directly to General Motors and General Motors goes bankrupt, since this was direct finance, you had an asset, you lose. If you put your money in a bank and the bank lends money to General Motors and General Motors goes bankrupt, General Motors doesn't pay back the bank, but the bank still owes you the full amount of your asset. Right? So that's the real distinction here. That intermediary is standing in between the ultimate borrower and the original saver. Now, some of these non-bank financial institutions, in particular finance companies and hedge funds, are sometimes referred to as shadow banks. Actually, all non-depository financial institutions have sometimes been referred to as shadow banks, but finance companies, mortgage companies, and hedge funds in particular seem to fall into that category. So they're all shadow banks in the sense that none of them take deposits. Right? So you don't have that depository institution aspect. And as we'll see, there's some other characteristics of shadow banks as well, and that's particularly true for finance companies, mortgage companies, and hedge funds. Because these are institutions that don't take deposits, they are said to be operating in the shadows of commercial banks, which is why they're called shadow banks. Much of their activities are very similar to what banks do. Rather, banks gather deposits, make loans out the other side. Insurance companies, pension funds, hedge funds, mutual funds, finance companies borrow money from savers, lend it to borrowers. Right? So we have many of the same types of activities. What we don't have is deposit taking. Now, with those three that I highlighted, finance companies, mortgage companies, and hedge funds, what we also have is three basic characteristics. They are much more lightly regulated than banks. They are much more highly leveraged than banks, and they fund themselves primarily with short-term financings or short-term borrowings. All of these are critical aspects of shadow banks, and they also make shadow banks more fragile, that is riskier, than commercial banks themselves. We'll see how that works in just a few minutes. Now, when we look at these different types of financial intermediaries, what we actually see is that there is a difference between them based on the liabilities that they issue and the deposits that they, or the assets that they hold. Right? So as you can see, commercial banks make business and consumer loans, mortgages. Their primary liability is the deposits that they have. If you come down to, say, a finance company, you can see it makes consumer and business loans, competing with banks. But their liabilities are not deposits. Rather, it's things like commercial paper, stocks, and bonds. Mortgage companies, which is not on this chart, they would be making primarily mortgages. Right? So again, they would be competing with banks on the asset side, but their liabilities would be primarily things like commercial paper, stocks, bonds, other types of short-term borrowings. So what we see with shadow banks is that they often compete for business with commercial banks, not necessarily in the broad range of things that commercial banks do, sometimes in a very narrow niche of what banks do, but they typically also fund themselves very differently than commercial banks themselves. Now, it turns out, for a variety of reasons, that commercial banks are particularly important in the way the economy operates. One of the reasons that they're different is that commercial banks as depository institutions are the way that we actually hold our money, or at least a part of our money. So remember, the money supply is currency plus deposits. So those deposits only exist in commercial banks. They do not exist in non-commercial banks or shadow banks, non-commercial, non-bank financial institutions. So banks are there or depository institutions are there as an important way in which we hold our money. A second important reason, because they are depository institutions, this is where the central bank has the greatest effect. When the central bank does open market operations or it changes required reserve ratios, it affects the amount of reserves and deposits in the banking system. So when the central bank wants to change the money supply, those changes get pushed through the commercial banking system. This is why, as we saw last week, if the commercial banks decide to hold excess reserves rather than lending it out, not a whole lot happens to the money supply. And in third, if we're going to get a multiple expansion of the money supply, again, something presumably that the central bank would like, then we also need to have commercial banks with a fractional reserve banking system, again, to take deposits, hold some reserves, and lend out their excess reserves elsewhere. So this just provides a little bit of oomph to any kind of open market operation or change in the monetary base that the central bank would like to make. Without commercial banks or depository institutions, it's not that we can't change the money supply, it's just that it gets a lot harder. Now, once we make the transition to cyber monies, which I'm sure is coming in your lifetime, then some of this may actually change. But even cyber monies need to be deposits somewhere. And what we'll see is depository institutions may actually have to change, and the conduct of monetary policy may also have to change once cyber deposits take over from actual depository institutions. Now, while commercial banks are critically important in the conduct of monetary policy and for how the economy operates, commercial banks also have a certain amount of fragility or instability built into their financial structure. And we can look at this by examining the balance sheets that banks have. As we said with the Federal Reserve, balance sheets have an asset side and a liability side. So when we think about the assets of a commercial bank, they generally fall into one of these 6 categories. And I've grouped them with how we can think about them. The first group is kind of our reserves. So banks hold cash, either on deposit at the Federal Reserve or in their vaults, what we call vault cash, right? This is some funds that are inside the ATM machine, they're inside the bank itself, but are not yet in circulation in the economy. Some banks also have what we call liquid security holdings. These would be very short-term, generally government or very high-quality debt, the type of thing that can be sold very quickly if, in fact, they needed to raise more cash. So cash is what we sometimes call primary reserves. Liquid security holdings we would call secondary reserves. Liquid security holdings do not count against required reserves. Now, the second, and by far and away the largest component of what's on a commercial bank's balance sheet, are investment securities and loans. And even here, it's mostly loans. So investment securities are just, you bought a bond, you expect to hold it until it matures. It's not something that you anticipate that you'll ever sell, even if you need to raise additional cash. Right? Where liquid security holdings are basically kind of a operational liquidity for the bank. But investment securities would not fall into that category. In loans are all sorts of different kinds of things. So most bank loans fall into either consumer loans, so these would be loans for things like cars and trucks and airplanes and appliances, and student loans would fall into that category, something I'm sure none of you know anything about. So anything that a consumer might want to borrow money from a bank to finance, with the exception of real estate. So real estate loans turn out to be the biggest category of loans, of any of the loan categories on a commercial bank's balance sheet. So in the aggregate today, real estate loans are about 50% of the total balance sheet, or the total assets, I shouldn't say total balance sheet. Now, real estate loans includes mortgages, it includes first mortgages, it includes home equity lines of credit that have been drawn on, but it also includes loans to real estate developers and builders, home remodeling projects, all of those types of things, something that is secured by underlying real estate. And commercial loans are simply loans to businesses that do not involve real estate, whatever it might be, to expand a business, to finance inventory holdings, to meet your payroll, to pay your taxes, whatever you might be doing with it. And of course, there's always that other catch-all category of other that has a bunch of stuff in it. Okay, now, if we come back here, we also see there are 2 other categories. Again, a catch-all category of other financial assets, which can be all sorts of weird and wacky things. And then finally, non-financial assets. One of the things that you've probably noticed is almost every bank owns a building or owns the land that the building's on. It owns office furniture, right? Computers, all that kind of stuff would be considered non-financial assets. What we want to focus on, though, is that investment securities and loans, and in particular on the loans. So that's where we're going to focus our attention. Now, the other side of the balance sheet, the liability side, actually has 3 components. For a commercial bank, it includes deposits, right? This is all the money that we put into our bank accounts. It also includes non-deposit borrowing. So remember, a deposit is kind of like borrowing. The bank has borrowed from you, owes you the money back that you have in your checking account. So we can think about deposits as a way of borrowing.